All right. Welcome, everyone. Today, we're going to walk through a comprehensive investment review guide for 2026. This webinar is specifically tailored for federal employees between the ages of 45 and 60, which means you're at a critical planning window. Whether retirement is 5 years away or 20, the decisions that you make right now will have a major impact on your financial security in the future. So let's get started. My name is Mark Humphreys. I'm the founder of Sentinel Financial Planning and a former federal employee. We help federal employees and your families plan for and manage your investments. One item I'd like to highlight, we're a fee-only firm. Fee-only financial planners are fiduciaries, which means we put your interests first. Being fee-only minimizes conflicts of interest, and we don't sell products for a commission. Why does today's webinar matter? So you're in what financial planners call the accumulation to transition phase. You've been saving and building wealth, and now you need to start making sure everything is positioned correctly for your transition point. As federal employees, you have a unique benefit package: your FERS pension, the TSP, and Social Security. But those benefits only work well if they're coordinated with your other investments. This webinar will help give you a structured way to make sure nothing is being overlooked. Think of it as a financial checkup. Here's what we'll cover. We're going to move through four major areas: investment objectives, investment issues, tax issues, and a few other important items. At the end, we'll talk about concrete steps you can take this week. This material is designed to be practical, not theoretical. I want you to leave here with something actionable. So let's start with the foundation, your financial goals. When was the last time you actually wrote down what your investment portfolio is supposed to do for you? For many of us, the primary goal is retirement. But has your target retirement date changed? Maybe you were planning to retire at 60, but now you're thinking 57, or maybe you're thinking of working until age 62. That changes everything: your time horizon, your risk level, your withdrawal strategy, many things. Also, if you're planning a major purchase, maybe a retirement home, helping a child with college, or paying off your mortgage, that affects the amount of money you need and when. And if you want to leave assets or accounts to children or grandchildren, you'll need to make sure those accounts are titled correctly and addressed in your estate plan. These are foundational questions, and they should be visited at least once a year. Now let's talk about risk tolerance. This is not just about whether market drops make you nervous, although that matters. Risk tolerance has several dimensions. There's your risk capacity for risk, which is about your financial ability to absorb losses. If you have a solid FERS annuity and Social Security, your capacity for risk may be higher than you think. Then there's your need for risk. If your portfolio needs to grow significantly to meet your financial goals, you may need to accept more risk than feels comfortable. The phase of life matters too. At 45, you likely have 15 to 20 years of growth ahead. At 58, you might be 2 years from retirement. These are very different situations. The key is to make sure your portfolio's risk level actually matches your current reality, not the risk level you set when you first opened the accounts. So this is one of the most important questions you can ask. Am I on track? And honestly, many people are afraid to look, but the math is straightforward. Start with your expected return assumptions. Are they realistic? If you're assuming 10% or higher annual returns, that may be unrealistic. Most balanced portfolios are projected in the 5 to 7% range over the long term. Then factor in taxes and inflation. A 6% return with 3% inflation and a 22% tax rate leaves you with roughly a 1.6% real after tax growth. That's a very different picture. Also, review your life expectancy assumptions. Planning to live until 85 might not be enough. Many people live well into their 90s, and running out of money at age 88 is not a plan. If you're already taking distributions from any account, make sure the withdrawal rate is sustainable. This is where federal employees have a real advantage, and I want you to understand just how powerful it is. Your FERS pension provides a guaranteed inflation adjusted income stream for life. Social Security provides another one. If you retire at your minimum retirement age before 62, the FERS supplement bridges the gap, and the Federal Employee Health Benefit Plan carries into retirement, reducing a major expense that private sector retirees struggle with. Here's the key insight. When you have reliable income from a pension and Social Security that cover your basic living expenses, the money in your TSP and other investment accounts don't need to be your lifeline. It becomes supplemental. That means you can potentially afford to keep a more growth-oriented allocation longer because you're not depending on the portfolio for expenses like groceries or rent. This is a real strategic advantage, so make sure that you use it. A special note on this, as a federal employee with these benefits, you most likely do not need an annuity or life insurance product from a private insurance company. Again, as a federal employee, you likely do not need an annuity or life insurance product from a private insurance company. How are you measuring performance? Most people log into their TSP, see if the number went up, and feel good or bad based on that. But that's not really a performance review. Are you comparing your returns to the appropriate benchmark? If you're in the 2035 L fund, are you comparing it to similar target date funds, or are you comparing it to the S&P 500, which isn't an apples to apples comparison? Also, are you looking at performance after fees? The TSP has some of the lowest fees in the industry, which is great. But if you also have an IRA with a 1% advisory fee and a fund with a 0.75% expense ratio, that's a meaningful drag on returns. And most importantly, are you looking at your total portfolio performance across all of your accounts or just the account by account? Your overall picture is what matters here. A sidebar about fees. Cheapest is not synonymous with the best. Consider what you're receiving for the fee that you pay. Price is what you pay, value is what you get. The TSP does not provide financial advice, it's simply a savings plan. So if you're paying a 1% advisory fee, you should be receiving some type of value. So let's pause here for our first checkpoint. I'd like you to take a moment and ask you to honestly assess, how many of these items can you check? Are your goals documented? Have you reviewed your risk tolerance in the past year? Are you sure whether you're on track or not? And don't worry, that's exactly why we're here today. The point isn't to have all the answers. The point is to know what questions to ask. We'll talk about how to get these answers at the end of the presentation. Now we move on to our investment issues. And the first one is critical, your overall asset allocation or investment mix. I can't stress this enough. You need to look at your entire financial picture as one portfolio. That means your TSP, any traditional or Roth IRAs, any taxable brokerage accounts, your spouse's retirement accounts, everything. Why? Because you might not think you're diversified, but in your TSP, an 80% allocation in the C fund and your IRA and the S&P index fund, you're essentially doubling down on the same thing. Pay special attention with taxable accounts. You could inadvertently trigger what's called a wash sale violation. If you're selling a fund at a loss in one account while buying a substantially identical fund in another, take the time to map out everything in one place. A simple spreadsheet can work. Just list every account, every holding, and see what your true allocation looks like. So next, how did you choose your investments that you currently hold, and when was the last time you checked on them? For the TSP, fund options are limited, which might simplify things. But for your IRAs and other accounts, you may need to be more intentional. Look at the expense ratios. If you're paying 0.8% for a fund that does the same thing as one costing 0.05%, this difference compounds dramatically over 15 to 20 years. What is your investment philosophy? Does it still make sense? Are you a passive or active investor? Do you understand the differences between these philosophies? And on the monitoring side, check if there are any changes to fund managers. A fund can become a mediocre one when the team that built the original fund leaves. For passive investors, rebalancing is one of those things everyone knows that they should do, but few people actually do it consistently. Over time, your winners grow to become a larger share of your portfolio and the losers shrink. That means your actual allocation drifts away from your target. Rebalancing forces you to sell high and buy low, which is exactly what most investors can miss. There are two main approaches. You can rebalance on a schedule, say every January, or you can rebalance when the asset class drifts more than 5% from its target. Either approach can help. The important thing is to have a system. In the TSP, interfund transfers are not taxable. Just be careful with taxable accounts where selling can trigger a tax implication. And remember, rebalance across all of your accounts, not just within one. So on this slide, this is one of the most powerful and overlooked strategies, especially for federal employees who often have multiple accounts. Asset location is different from asset allocation. Allocation is what you own. Location is where you own it. Here's the principle. Put your least tax efficient investments in your most tax sheltered accounts. Bonds, real estate investment trusts, and actively managed funds that generate taxable income or short term gains can go in your traditional TSP or traditional IRA, where you won't pay taxes on the income until you withdraw it. In your taxable brokerage account, hold individual stocks, tax efficient index funds, or ETFs that generate minimal distributions. And in your Roth accounts, Roth TSP or Roth IRA, hold your highest growth investments because all that growth comes out tax free. Getting this right can add meaningful value over time without changing your risk level. Concentration risk is when too much of your money is tied to a single investment. A classic example of this is single company stock. But for federal employees, this can also show up as an overallocation to the G fund or the C fund within the TSP. If you hold individual stocks in a brokerage account, take a hard look. No single position should represent more than 5 to 10% of your portfolio unless you have a very specific reason and understand the risk. On a different note, If you care about aligning your investments with your values, environmental, social, and governance issues, also known as ESG, there are more options available today than ever. ESG and socially responsible investing strategies exist across many asset classes. Just document your preferences and rationale so that your advisor can incorporate them properly. So, how many accounts do you have? I find that federal employees in this age group often have their current TSP, an old 401k from a pre government job, a couple IRAs, and perhaps a spouse's accounts. It can get unwieldy. Consider consolidating where it makes sense. Rolling an old 401k into an IRA prevents the money from being lost, and it gives you more control in investment choices. However, rolling an IRA into the TSP can make sense too if you want to take advantage of the TSP's low fees. Just be aware of the rules. Some rollovers are straightforward, others have tax implications. Also, make sure you're taking advantage of every tax preferred account available to you. If you're contributing at least 5% to the TSP, you're getting the full agency match. That's free money. Don't leave it on the table. If you're in a high deductible federal employee health benefit plan, an HSA is one of the best savings vehicles in the tax code. Money is tax deductible going in, it grows tax free, and is tax free coming out for medical expenses. And if you're saving for a child or grandchild's education, 529 plans offer state benefits as well. So now let's talk about taxes, because taxes are one of the biggest drags on investment returns. If you have a taxable brokerage account, you need to be strategic about how you generate income from it and how you manage capital gains. For 2026, the long-term capital gains rates are shown here. Many federal employees in this age group will fall in the 15% tax bracket for long-term gains, but it's worth checking. If you're married filing jointly and your taxable income is under roughly $99,000, your long-term capital gain rate is actually 0%, which means which may create some interesting planning opportunities, particularly in early retirement years before Social Security and RMDs kick in. A special note, if your modified adjusted income exceeds $200,000 if you're single or $250,000 if you're married filing jointly, you'll also face the 3.8% net investment income tax on top of capital gains rates. For higher earning federal employees, especially dual income households, this is a real factor. Municipal bonds, which are exempt from federal tax and often state tax, can be a useful tool to help manage this. Tax loss harvesting. This is a strategy where you'll sell investments that are at a loss to offset gains elsewhere in your portfolio. You can use losses to offset unlimited capital gains, plus up to $3,000 of ordinary income each year. Any unused losses carry forward to future years. One powerful technique, if you own a fund in multiple tax lots, meaning you bought these shares at different dates and different prices, you can use the specific identification method to sell only the highest cost lots, maximizing your realized loss. But there's an important rule. The wash sale rule says you can't buy any substantially identical investment within 30 days before or after the sale. You can buy something similar, but not identical. So for example, you can sell an S&P index fund and then buy a total stock market fund. Similar, but not identical. More broadly, if you're trying to minimize your overall tax bill, limit unnecessary trading in taxable accounts. Every time you sell at a gain, that's a taxable event. Long-term capital gains are better than short-term capital gains, which are taxed at ordinary income rates. And if you own mutual funds, be aware that the fund itself can distribute capital gains to you at the end of the year, even if you didn't sell anything. That's out of your control, but something to watch for. So here's a tax issue recap. Let's do our second checkpoint. Take a look at these tax-related questions. For many federal employees, the tax picture gets more complex as you approach retirement. You might be in your peak earning years, you might have a working spouse, and you might be starting to think about Roth conversions or other tax planning strategies. If you can't confidently answer most of these questions, that's a strong signal to work with a tax-aware financial professional. The cost of getting tax planning wrong over a 20-year retirement can easily run into the tens of thousands of dollars. So let me touch on a few other important items before we wrap up. First, do you have a plan for market declines? And I don't mean just to stay calm. I mean an actual written plan that says what you'll do, or more importantly, what you won't do if the market drops 20 or 30%. The data is overwhelming. Investors who panic sell during market downturns lock in losses and miss the recovery. Having a plan in writing helps you stick to it. Second, do you understand all the fees that you're paying? And more importantly, understand what you're getting for those fees. TSP fees are about 0.05%, which is nice. However, you're only getting the savings plan. But if you have an advisor with a 1% advisory fee, you should be getting personal financial advice on topics like retirement, investing, estate planning, taxes, and insurance. Third, contributions. Are you maxing your TSP? In 2026, if you're 50 or older, you can contribute up to the catch-up limit of $8,000 on top of the regular limit, which is $24,500. Make sure your contributions are allocated the way that you intend. New contributions don't always automatically follow your existing allocation unless you've set it up that way. And one note, if your FICA wages are more than $150,000, you might be required to make Roth catch-up contributions. And finally, make sure the people helping you, your financial advisor, your accountant, your estate attorney, are all on the same page and their roles are clear. So here's what I'd like you to do after our presentation today. First, take the checklist handout that I'll send out once the webinar is over and go through each question and mark yes or no. Wherever you've marked yes, this needs attention. That becomes your to-do list. Second, set aside time to pull up all of your accounts, your TSP, your IRAs, your brokerage account, spouse's accounts, and look at the total picture. You might be surprised by what you find. Third, check your FERS pension estimate. You can do this through your agency's HR system or the OPM retirement calculator. Then go to ssa.gov to get your latest Social Security statement. Know what you're projected to receive because that's the foundation the whole plan is built on. Fourth, if you don't already have a relationship with a qualified financial professional, consider starting one. The complexity only increases as you approach retirement, and having an expert in your corner is worth the investment. And finally, put a recurring date on your calendar, at least once a year, to repeat this review process. Your life will change, markets change, tax laws change. An annual review keeps you on track. So, with that, I would like to thank you for your time today, and I'm happy to take any questions that you might have. You can drop them into the chat there, and I will be sending out the checklist as soon as we wrap up. If not, we are right in our time frame here. We have 2 minutes before 10:30. I know you guys have lots of work to do. All right, so I'm not seeing anything, but keep an eye out for the checklist. That'll be coming to your email here shortly, and feel free to follow up with any questions that you have. Have a great day.